we went and raised a large chunk of money for them and negotiated with them for better terms and than an individual would get coming in. And it really dawned on me this year that being able to find better terms is the name of the game. And the only way you can really do that is through scaling.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Daniel Holmlund started the Alternative Investing Club, which helps educate people in creating an ownership culture. And he's also an active commercial real estate investor. And Daniel, I know that bio just doesn't even remotely capture everything that you've done in commercial real estate. But either way, it's great to have you on the show.
Hey, Sam, it's great to be here. I love seeing that you put out a daily podcast, and I know a little bit about the rigor that entails. So congratulations to you too.
Well, I can't say it's daily anymore. Regrettably, we did 700. I don't know who is we. We got a mouse in my pocket. I do have a lot of help. So maybe it is a we. It is definitely a we. Podcasting is a we sport. But we did 720 episodes. So 2 years straight daily. And then we've moved to 3 days a week. So we're only at 3 days a week now. I can't claim a daily real estate show anymore. But either way, Daniel, this show is about you, not me. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Sure. So when I was little, my grandparents bought a apartment complex after my grandfather retired from International Harvester. It was only after he retired from his full-time job and bought real estate that he actually amassed any wealth. And that it kind of struck me as a 10-year-old. So I started right out of college buying properties in single-family homes, usually adding a little value there, flipping them. That was in 2002. I invested as a hard money lender from overseas, actually, all during 2006 to 2008. I ended up through the 2008 with a couple of houses that hard money lenders didn't want to pay me back for. Kept those for a little while, and then founded Good Samaritan Capital, which is a syndication and private equity real estate company in 2018. And I have been working on private equity commercial deals ever since.
Okay, that is really cool. I mean, but you've also held a W-2 here until recently, if I'm not mistaken.
Yeah. So I until just this year, I was full-time at Intel, where I worked on video and artificial intelligence. I was a trainer for these, so I didn't actually write the software, but I trained people on how to use it. And I also started the real estate club at Intel, which has been going now strong for 4 years. It's just exited Intel, and we rebranded ourselves the Alternative Investing Club. And we bring a speaker in every single Friday and just learn from great people who are out there doing it.
Let's stay there for just a second, because I think this is something really cool that you set up there at Intel. You guys, like you said, you had a weekly meeting. You brought in a speaker every Friday. I think you had, parameters around it, which make all the sense in the world. It's a no pitch, educational only. And I actually got to present there for you.
Yeah, you did. You presented on syndicating parking lots.
Yeah, that was 3 years ago.
Like 3 years ago. Yeah.
Yeah, 3 or 3.5 even, which was fun. Yeah, it was great. It was great. It was great to be there. One, how did you build that club? And then what advice would you give to somebody else thinking about that? Because, I mean, you guys are at Intel. You're not there to talk about real estate. You're talking microprocessors and all the other probably 800 billion things that Intel's involved in.
Yeah. And actually, I not only helped to build the club at Intel, but in 2021, I started just a small pro bono mastermind helping other people start clubs. And we helped start the club with Misi over at Walmart, over at Netflix, at Cisco, we revitalized the club over at Apple. We started one at Facebook, and so we built a little bit of a network there. And they're actually totally independent from me and off doing their own deals, starting their own clubs. But in Intel, I basically went into HR and said, "I see you've got a stock company or a stock club. I see you've got a startup club, and I want to run the real estate club." And my advice to people wanting to do that is figure out who to talk to at HR and make sure that you frame it in terms of, I am making this company a better place to be.
Right.
Intel needs to be a great place to work, and because of that, we're starting this club, which is purely educational and also networking.
Right. Right. That's cool. That's cool. Yeah, I love that. I mean, again, I've never spent a day in corporate America, so I wouldn't even know where to start on that front. Like, oh, hey,
Well, some corporations are love the idea that you have the enthusiasm. Some are really conscientious, and they'll put like the compliance officers in the audience to monitor you. Which you should be compliant. You should be running a purely educational club.
right.
So just work with them and make sure that you keep the HR people happy and provide great speakers to your club members.
Right, right. No, I think that's great. How long did it take for you to get traction on that front?
Oh gosh, my first 4 months running that club, I was embarrassed to go out to speakers. I was like, "We're the Intel Club. We've got like 12 people that are showing up."
Yeah.
But what I did that actually grew the club is I went to other clubs, and there's a 20s and 30s professionals club called uh, uh, Next Gen Professionals at Intel, and I said to them, "Hey, can I get on your calendar?" And this is what we do. So I went and networked with other clubs, and that's actually what caused my growth to explode. And you can see a very nice progression up over the last 3.5 years. We're now at almost 1,100 members.
Wow. That's really, really impressive. And that's something, I mean, I'm assuming you've done essentially with no marketing, no advertising.
In fact, I was forbidden from doing that at Intel. It was all word of mouth.
Right. Right. Oh,
Yeah.
that's really, really cool. I love that. And I think that's the other thing is, and I think even back to launching a podcast where it was like, I don't know where we are, 830, 850 episodes, somewhere in that range. And it's like the first few episodes, it's like, man, why am I doing this? Like, I think God bless the guy that came on at 7 downloads, I think was on my first episode published. Like, oh, after a week, I had 7 listens. Whoop-de stinking do. Why are we doing this? And obviously that's changed, but I think anybody starting out, scaling what they're doing, just has to know there's that incubation period. There's the embrace the suck period of like, well, hey,
Oh yeah.
hat in your hand, will you come talk to my 12 friends at Intel? Because our group is
At the very beginning of the club, we actually used to reserve a room and physically go there. And I realized at one particular time, nobody showed up in the room, but there was like 15 people online. And I looked at them. They were all in the same building as I was in. They were just at their desks. And so you go through periods like that.
right. Right. And did you get and did that change the model or the way that you did it from then on? Did you do it all remote after that? Just
It's
because
completely remote. Most of our attendees, the number one spot is actually from Folsom, California. Number two is Portland, Oregon. Number three is Phoenix, Arizona. So we're a lot of West Coasters. There's some Texas and Virginia and other places thrown in, but yeah.
got it. Oh, that's really, really cool. I love that. And so how did you take that club out of Intel? I mean, did you just take all your email list and say, all right, guys, we're going to move this club. I'm not hosting it here at Intel anymore because I've stopped working
Yeah,
there?
pretty much. Yeah, over about a 8-week period. I said, first of all, we posted all of our videos internally while the club was happening in Intel. Only Intel employees were allowed to go there, so we posted our videos internally. We couldn't even send them to our speakers, right? And well, actually, that's not true. We could send them to our speakers, but we asked they not share them.
Right.
And the reason why is because Intel wanted to protect the privacy of their employees, and that was the HR policy that we had to abide by.
Right.
And so going out of Intel, it's been a big process. We basically told everybody, hey, if you want to continue coming to the group, sign up on this external emailing list in order to get on the group. And we're going to go through all the videos and make sure that names are blurred out, that anything that reveals any sort of employee name or data is taken out, which was hard because we did question and answers where I would say Bob is asking da 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 da.
Right.
And I realized actually early on that just using first names and not whole names was a good way to go because it meant a whole lot less editing.
Right.
But basically, we just told the group that we were moving externally, and we moved over to alternativeinvestingclub.com, and that's where we're hosted now.
That's really cool. Yeah, I love the idea of protecting the kind of the privacy of the people who are in the meeting. Here's a rookie mistake I made the other day, Daniel. I was doing a webinar and I was using Zoom, and I'm too cheap to pay for the webinar version of Zoom because it's like another, I do like 2 webinars a year. So I was like, and I pay for
I
obviously
think it's like
being,
$400, isn't it?
it's
For
something like
one of their,
that. But
yeah,
I'm
a month.
it's high when you tack on the webinar feature. I'm like, man, I don't really care about that. And you can do speaker only view because none of the attendees in the webinar needed to be there. But I failed to do that, and so it had everybody's names who was attending, obviously a webinar for our clean laundry fund. And I'm like, crud, there's all the, so my video editor get in there and blur everything out. And like, but it just wasn't quite the but same idea where it's like, oh
Yep.
crud, everybody doesn't want to get advertised that, hey, I was in this meeting. And none of my investors want to get advertised to the world that, hey, they were attending a webinar for our clean laundry fund. So it's just like,
Yep.
you got to protect those things. So very, very cool. We've talked a lot about the club and how you started at Intel, what you've done to move it to taking it out of the corporate America structure. What are some things you're doing differently now inside of that club that maybe you couldn't do before at Intel?
Well, for one thing, we're beginning to bring in actual, pitches to the club. So if people want to come in and talk about their clean laundry fund, we're doing more of that, where it actually is listed to the attendees that this is a pitch for a particular fund. And this is not a non-educational one. One thing I want to back up and say actually is that the real estate club for me was my launching platform for starting Good Samaritan Capital. So it was a networking group, and I did a ton of networking, never using company resources. I always called on Zoom outside of company resources, never doing anything like that. But I built up my investor list that way. And Good Samaritan Capital over the last 5 years now has participated in 12 syndication deals. It Two of which we have sponsored, and then two fund to fund deals. I'm sorry, three of which we've sponsored, and two fund to fund deals. And so our goal was to bring a new, high quality, vetted investment out to the attendees, or people, rather, not the attendees, but the people on my investor list. There's actually a lot of people attending who are not on my investor list. Um, and bring it out once a quarter. So we hit that goal every single quarter, except for Q4 of 2022, where interest rates were starting to peak up really quickly and liquidity was drying in the market. Those are still the current conditions that we're in, and I'd love to talk about that as well too.
Yeah, shoot, man. No, let's talk about. I mean, that's a lot of deals to get done, and you essentially what you just said. If I can recap it and clarify, is that you built your investor list by hosting these events and by starting these clubs.
Absolutely.
That's
Yeah,
really cool.
absolutely. And it's straight out of the best ever real estate syndication book, right? Create your thought leadership platform.
Right.
Create a thought leadership platform and become the expert to a group of people that you know, and earn their trust through repeatedly being there. Our club has actually had an average of 49 events on Friday for the past 4 years. So
Wow.
we usually don't do the Friday after Thanksgiving, and maybe one or two in December. But other than that, we're there like clockwork. And that's a way to create trust.
Yeah, absolutely. Absolutely. Very, very cool. You wanted to talk about interest rates, not getting a deal out in the last quarter. What has been your focus and where are you going now that we've kind of, things.
Yeah. So it's interesting. I think that a lot of people that are in the real estate market right now are realizing, and actually in the club, we've been warning for 2 years. I was joking back in 2021 about which is more transitory, inflation or the Fed, or the Fed's reputation. Uh, and I think now it might be the Fed's reputation, right? And that's actually what we thought back then too. But the writing was on the wall for quite some time. And in fact, one of the reasons I started a real estate company is because I knew I needed to convert all my stock market funds into real estate and hard assets, because we were going into an inflationary period. and my thesis was always that inflation is starting to pick up. The way that governments are spending is going to necessitate that inflation picks up, but all it's going to take is a shock to the system to make it really jump up.
Right.
And we've seen lots of shocks to the system. Of course, nobody thought COVID would come around, but it only takes a shock to the system, and shocks to the system happen a lot. The economy tends to position itself right on the knife's edge,
Mm,
right? Where we've borrowed just enough to make inflation not a problem if everything goes right. Well, what if everything doesn't go right? You want to be in assets that are tangible and that actually go up in value in inflationary environments. And
right.
that was the core theme to my business, 5 years ago. And the writing was on the wall since 2013, where but anyway, I won't go down that route. So so we now are in a period where inflation's kicking up, expenses are going up, the interest rates are going up. This is drawing up a lot of liquidity in the market. A lot of lenders have drastically pulled back. I see deals right now that used to be underwritten for 75% LTV, loan to value,
Yeah.
and now they're doing 65 or
Oh, yeah.
60%. And so syndicators are raising a lot more capital in order to get their deals done. They're paying 7% pref, 6% pref, whatever they happen to be paying, which is not as competitive as it used to be when interest rates were down at 2%.
Right.
If you can borrow money at 2%, why pay 7% pref? Well, now they're getting a lot more closer to each other, which is causing pref to move up potentially in some types of deals.
Yep.
And so a lot of lenders are pulling back, and it's creating demand for private equity, for increased amounts of equity, and for mezzanine debt, particularly with operators who are running into cash flow issues or maybe didn't buy rate locks. And so a lot of distress is starting to come into the market, and that's kind of been our theme this year. Last year, our theme was, and the 2 years before actually, was flight to quality assets, where we invested in A minus and B plus multifamily assets. We also bought an industrial asset in Kansas City, which is doing well. And this year, it's going to be opportunistic to a certain extent, deals with pref equity. And so Good Samaritan Capital has shifted its strategy a bit. Last year, in our flight to quality deals, we started what's called a fund of funds, and we went and invested with large operators like Rise 48 and Lone Star, and big operators who had a good track record of paying out dividends, not dividends, distributions. And so we went and raised a large chunk of money for them and negotiated with them for better terms and then an individual would get coming in. And it really dawned on me this year that being able to find better terms is the name of the game. And the only way you can really do that is through scaling. So I'll stop there because I've been talking for a little while. I could keep going, but I'll let you get a word in.
No, this is good. I'm loving hearing the thought process, how you guys have shifted, what you are looking for, what you previously invested in. We're running out of time, but I do want to hear about, because we've kind of gotten the back picture on where you've seen things and how you guys are shifting your strategy, but you've launched a growth fund. I do want to highlight
Yes.
this before we get off the call here, which is talk about your growth fund, because I think inside of that, when you talk about the 4 different things you guys are doing, will really help kind of backfill the rest of what you were previously talking about.
Yeah, it's realizing that scale was needed in order to be able to come to the table and get better terms. We've launched the Good Samaritan Capital Growth Fund. It's a 506c fund for accredited investors, and we are targeting 4 main strategies, which we think are particularly good in this environment. In fact, I think there's a short window for it in this environment. And the first one is new construction. In the short term, we're going to see a lot of cash flow crunches. And so I want our focus to be on the areas where we can deliver for our investors, and that's in long-term growth. So we're looking at new construction, particularly new construction of land that is already permitted and already has the architectural diagrams signed off by the counties. So we come in, we'll buy the land, the permits, and the diagrams, and then partner with new construction companies in order to build mid-sized multifamily, 30 to 40 to 50 units. That's strategy number one. Strategy number two is a continuation of our previous flight to quality strategy, where we invest in multifamily that is long-term and is either A minus or B plus. And usually I like to see some sort of tax abatement. Taxes are the largest expense in a multifamily deal. If you can reduce that expense, which a lot of municipalities right now are offering tax abatements because there is an increase in affordability. So the county's coming in and helping you subsidize your renters in many cases, and there's different types of deals. The second and third, I'll do really quickly. There is an opening right now for pref equity. Deals are beginning to become cash flow constricted, and maybe they just need to finish off the last couple of units that they're doing. So there's a pref equity play, which is in high demand right now. The drying up of markets and the unwillingness of banks to lend, or only lend to large players, has created a vacuum there. And there's an opportunity to step in with pref equity. And then just slightly further up on the capital stack is the mezzanine debt. There's a great opportunity for mezzanine debt financing as well. So the long-term plays are the new construction and the value add, and the shorter term kickers that generate a kick in the fund are the pref equity and the mezzanine debt. And so those are the areas we see as being good places to target this year.
Daniel,
and probably next year.
Absolutely. No, that's incredibly insightful. I mean, we could spend the next 2 hours really just breaking down each of those different components, how you vet, how you choose to work along, who you choose to work alongside, and, not winding up like you did in 2008, owning assets that you don't necessarily want. How do you guys structure, and we could get into all of that. So maybe you need to come back on the show and we'll go, or not recap, but go through all of those and get a little bit deeper dive into that. For those of you who don't know, Daniel was one of the early people here on the podcast that came on. Daniel, last time you were on the show, it was December 16th, 2020. And you,
oh my goodness,
I know, you were episode number 17. So thanks again for you came on early, man.
That's awesome.
Thanks for gambling on me. Certainly appreciate you having you come back on the show here today, Daniel. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
You can reach me at Daniel@GoodSamaritanCapital.com. And
Daniel,
our website, GoodSamaritanCapital.com.
GoodSamaritanCapital.com, or Daniel@GoodSamaritanCapital.com. Make sure we include all of that there in the show notes. Daniel, thank you again for coming on today. I do appreciate it.
Thank you very much.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.